Good morning, Venture Capital. This is Metagame, and today's episode is about the massive funding rounds flying under the radar and the revolutionary robotics companies reaching for the stars. What if I told you that 4 companies just vacuumed up over $2 billion in a single quarter, and not one of them is building another chatbot wrapper? While half of Silicon Valley is busy slapping GPT-4 on a landing page and calling it innovation, the real money is flowing somewhere else entirely. Somewhere most VCs aren't even looking. Today, we're going to talk about infrastructure. Not the boring kind. The kind that prints money while everyone else fights over table scraps. Let's start with the most audacious raise of the quarter. Kalshi, the prediction market platform, just pulled in $1.24 billion. That's billion with a B. And before you dismiss this as another fintech vanity round, understand what's actually happening here. The SEC filings show this came in at least 3 separate tranches, $820 million, $294 million, another $125 million. That's not a fundraise. That's a war chest being assembled in real time. Fortune confirmed Coatue led at roughly $22 billion valuation, which puts Kalshi slightly ahead of Polymarket in the prediction market arms race. But here's where it gets interesting. The CFTC under Trump-era leadership just signaled federal support for prediction markets. Meanwhile, individual states are pushing bans and restrictions. You see what's happening? This isn't growth capital. This is survive the regulatory Thunderdome capital. Kalshi operates under CFTC oversight, which theoretically means 50 state access. But state-level pushback could fragment the market or impose compliance costs that only the best-funded player can absorb. The multi-tranche structure tells you everything. Investors wanted proof points, user growth, regulatory wins, liquidity depth. They weren't writing a blank check. They were buying options on each milestone. And now Kalshi has the deepest war chest and the most federal air cover in the category. When regulatory risk is existential, capital flows to the player who can outlast the uncertainty. Everyone else becomes a cautionary tale in a future podcast episode. Now let's talk about Ramp. $311 million, part of over $800 million in fresh ammunition across Q3 and Q4. And the timing here is not coincidental. Ramp's own research shows enterprise AI adoption hit 50.4% in March. Not projected, not forecasted, crossed. Think about what that means. More than half of enterprises are now deploying AI in production. And where does that AI show up first? Procurement, expense management, budget controls, the boring stuff that actually determines whether a company makes money. Ramp sits at that intersection: corporate cards, spend management, and AI-powered expense controls. As CFOs get AI-native procurement tools, the platforms that integrate real-time spend analytics, policy enforcement, and predictive budgeting become the system of record. Not a nice-to-have. The system of record. This raise is classic late-stage land grab. Sign the Fortune 500 logos before the category consolidates. Brex is raising, Airbase is raising, everyone is raising. But the winner will be whoever can prove that their AI actually saves money, not just promises to. Ramp's 50% adoption number is their proof point. They're not selling a roadmap, they're selling receipts. Now here's where we pivot from software to atoms. Stoke Space just pulled $410 million, but that's actually only part of an $860 million extended Series D. They announced the full number in February. The money is earmarked for launch, site activation, and scaling production of their Nova reusable rocket. This is milestone financing at its purest. Investors commit capital in tranches tied to technical achievements, test flights, engine validation, site build-out. The $410 million in the SEC filing is an earlier slice. The full $860 million reflects continued confidence as Stoke hits targets. And here's the uncomfortable truth for most VCs. Hard tech requires patient, programmatic capital. Unlike SaaS, where you deploy $50 million and scale ARR in 18 months, aerospace demands multi-year build cycles, regulatory approvals, physical infrastructure. The willingness of growth investors to keep feeding this round signals belief that Stoke can capture share in the new space launch market. SpaceX's dominance invites competition. Customers want supply chain redundancy. And Stoke just raised enough to build it. If you're underweight in hard tech because the capital intensity scares you, congratulations. You're ceding ground to funds willing to play the long game while you optimize for IRR on a 12-month horizon. Speaking of long games, let's talk about Apptronik. $331 million. But wait, that's part of a $935 million Series A. Yes, a near billion-dollar A round. For Robots, the investor roster mixes traditional VCs with strategic corporates and sovereign capital. That mix tells you humanoid robotics is transitioning from science project to manufacturing imperative. Apptronik is betting that general-purpose humanoid robots will penetrate logistics, manufacturing, and elder care, sectors where labor shortages and wage inflation are structural, not cyclical. You can't offshore a warehouse worker in Ohio, but you can replace them with a robot that works 3 shifts, doesn't need healthcare, and never files a workers' comp claim. Robotics companies are capital-intensive until they hit production scale, but the upside is replace human labor in entire industries' economics. If you believe the thesis, the time to invest is before the robots are on every factory floor and the category gets too expensive to enter. The $935 million proves someone believes it. Now let me connect these dots for you. Kalshi, Ramp, Stoke, Apptronik, 1.24 billion, 311 million, 410 million, 331 million. What do they have in common? None of them are building application layer commodities. Kalshi is building the liquidity network for prediction markets. Ramp is the spend management backbone. Stoke is launch infrastructure. Apptronik is physical automation infrastructure. Infrastructure has pricing power. Applications get commoditized by the next foundation model update. And here's the AI angle you might be missing. Even in prediction markets, fintech, aerospace, and robotics, AI is the invisible hand. Kalshi uses machine learning to price contracts efficiently. Ramp's entire value prop is AI native spend analytics. Stoke uses AI for trajectory optimization. Apptronik's robots are essentially AI agents in physical form, running vision models, natural language processing, and reinforcement learning. KPMG's Q4 data showed 26% of enterprises have already deployed AI agents. Average AI budgets hit $124 million. 67% of executives call AI spend recession-proof. That means every sector is embedding AI as core infrastructure, not a bolt-on feature. If you're not asking how does AI 10x this business model in every investment committee discussion, you're already behind. And if your portfolio is heavy on AI wrappers, tools that take a foundation model API and add a thin UI, you're exposed to margin compression as OpenAI, Anthropic, and Google race to zero on inference costs. The capital is voting, loudly, for picks and shovels over pickaxes, for infrastructure over applications, for regulatory moats over feature lists, for patient capital over quick flips. So here's your strategic framework. Question 1. Are you overweight in application layer commodities? Question 2. Do you have exposure to regulatory moat businesses where frameworks are being written in real time? Question 3. Are you patient enough for hard tech, or are you ceding that upside to infrastructure funds and sovereigns who can actually wait? Remember where we started? 4 companies. Over $2 billion, not one chatbot wrapper in sight. While everyone else is fighting over who can build the best AI assistant, the smart money is building the infrastructure those assistants will run on. The liquidity networks, the spend management backbones, the launch platforms, the physical automation layer. The question isn't whether infrastructure beats applications. The capital markets already answered that. The question is whether you're positioned to capture the upside or whether you're still chasing the application layer dream while the real money builds the foundation underneath it. Infrastructure is crushing applications, and now you know exactly where the capital is flowing. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.